Today, I'm going to be talking about estate planning for federal employees through the use of trusts and around the changing landscape in terms of the estate tax thresholds. So, I'm your host today, Neil Kane. I'm excited to walk you through this stuff. Let's begin with the dramatic shift in the estate tax exemption. If we roll back the calendar all the way back to the turn of the century, in 2001, we had a state tax threshold as low as $675,000. That means an individual who passed away with an estate of over 675,000 was leaving an estate that would likely have estate tax rates federally to their heirs in excess of as much as 50. Okay. We fast forward that to 2025. This estate tax threshold has been lifted to almost $14 million, right? With a top tax rate of 40% for those states that are over that amount. So, really, that means most of middle class America is not going to have an estate that is over $14 million per person. That's likely going to wipe out any federal estate taxes that are owed on someone's estate. Now, when we look at federal employees back in those early 2000s, living in a high cost area like Washington, D.C., had a home that was pretty high compared to the national average, had thrift savings plan as well as other income and benefits associated with being federal employees. Those federal employees often had estates that would have been higher than the $675,000 threshold. So in that case, a common strategy that was used was an irrevocable trust. Now, irrevocable trust, what it did was it moved assets outside of your estate and would therefore essentially preserve a higher estate tax threshold limit for you. So if 675,000 was an issue, you would essentially double that up by creating an irrevocable trust and moving some assets outside of your outside of your estate to a trust to then get a higher threshold. However, in today's world, the most important estate benefit is what's called the step up in basis. A step up in basis is actually not about estate taxes or avoiding estate taxes, right? It's about preserving a benefit which allows your heirs to avoid capital gains tax. Now, capital gains tax is a tax that all of us pay when we sell an asset that has appreciated in price. So, take an example, an asset that your parents purchased, like a home, for $100,000, right? That home is now appreciated. Give you the example of $500,000 today. Naturally, if your parents sold that home, they would pay taxes of $400,000, right, of capital gains on selling that home. However, if they pass away and you inherit that home, what ends up happening is the cost basis, aka the purchase price, now gets reset to the date of death, aka 500,000 today. Now there's 500,000 as the purchase price. If that property was sold by you today after inheriting it for 500,000, there's no capital gains, right? This is the important key part in terms of making sure that this part is preserved. However, in estate planning, you can't have your cake really and eat it too. It's got to be one or the other. You either create a trust that preserves the step up in basis, or you create a trust that avoids estate taxes and transfers assets out of your estate. But those trusts do not have a step up in basis. So the issue is a lot of these older trusts avoid estate taxes because they give you a higher threshold. However, they don't preserve the step up in basis. So really it boils down to the common trust used today is the revocable living trust because this preserves the step up in basis. So, how do you know if you have a trust that might be outdated? One is, when was it created? Was it created back in the early 2000s when we had a totally different tax regime. Was the main purpose to avoid estate taxes, right? Is there language in your trust like bypass or credit shelter in there? Does it contain highly appreciated real estate? So these are all things that you want to look at. And if that's the case, what you first need to do is sit down with that estate planner, if they're around, that originally wrote this, and take a look at that with them. See if this trust needs to be updated. Also, if you have a good CFP professional that has a good estate planning background, that would be a great start as well. Sit down with CFP, take a look at that trust, make sure it fits into this current estate plan. Also, double check your state. Your state may have what's called inheritance tax. So even though the federal estate tax threshold's at 14 million, you may be living in a state that has a $1 or $2 million inheritance tax threshold. Okay. Lastly, you can also look at updating your trust, especially if it's revocable. Now, if it's irrevocable, you can't typically update that, right? Because it's kind of locked in. But a revocable trust can. That's some of the benefits of that revocable trust and why we recommend them right now. So, our team is here to answer questions, or more importantly, walk you kind of through the entire wealth management process, which is what we do. We've been doing this now for over 10 years for our federal workers and families. We've got 4 CFP professionals. We've got our back office team as well as a CPA on staff. We would love to dissect your entire wealth plan, right? From all the way to retirement planning and income planning to taxes and estate. If that's something you're interested for, you can sign up for our retirement readiness meeting, which is QR code on the left. You can also go to our website, which is redfed.com/register. If you're not ready for that type of commitment yet, understand. Please like this video on YouTube, subscribe to our channel, go through some of our other videos as well, and educate yourself on other topics we have. But please send this to other colleagues and friends and welcome them to our YouTube channel as well. So that is how you can thank us back. Again, thank you for the time that you've spent to take a look at this video, and we will be posting a new video shortly. Thank you.